The August inflation numbers are out and they came in much worse than expected. The expectations for month-over-month inflation were that they would move down 0.1%, and in fact, they moved up 0.1%. Also, year-over-year inflation came in higher than expected, and it wasn't isolated to any specific category. The price increases were broad over pretty much every category. This means, coupled with some other indicators that we're going to look at, the Federal Reserve is almost guaranteed to raise rates by 0.75% next week, and there's a good chance they might actually increase their rate hikes to a 1% hike. Means much more aggressive tightening from the Fed, so brace for impact. Ready? Let's dive in. Let's take a look at the charts. This one's from Bloomberg. This shows the estimated year-over-year inflation was 8.1%, but it actually came in at 8.26%. So we can see here that this is still from June disinflation. Just in case you're not aware, disinflation refers to the change in the rate of inflation. So if the inflation rate is, let's say, 8%, that means prices are still going up at 8% every year. However, if last month the year-over-year inflation number was 9%, that means that the inflation rate is coming down. Prices are still going up, but the amount they're going up by is less. And so that's what disinflation means. So we've seen disinflation since June. That doesn't mean prices have come down. That means the inflation rate has come down. So prices are still increasing, just at a slower rate. Now, this number down here, the bar chart, this is going to be subtracting food and energy. So this is what the Federal Reserve really likes to look at. This is what they call the core CPI. Now this one, the estimation was 6.1%, and it came in at 6.32%. So again, above expectations. We know the Federal Reserve loves looking at core CPI because it excludes volatile food and energy, basically just excludes the things that people have to buy that are the demand for those things is non-elastic. So no matter what happens to prices, people will generally keep on buying those things because they have to survive. So the Fed likes to exclude those things from their favored measure. That way they get a better reading on CPI, but it's not working out so well lately because they're still getting bad core CPI readings. Now this chart is the month-over-month inflation rate. So instead of looking at August of this year versus August of last year, this is looking at every month compared to the prior month. And so we can see this is cyclical data here. And July, everybody was running victory laps in July when the month-over-month inflation came in at 0%. Now, everybody this month was expecting a better reading. Let's flip over to CNBC here, and it shows that the expectation for the month-over-month inflation rate was that it would fall 0.1%, but it rose 0.1%. So that is a big difference. And so across every measure here, whether we're looking at core CPI year over year, whether we're looking at headline CPI year over year, whether we're looking at month over month inflation, we are seeing worse than expectations across the board. Basically, what's going on here is we can't focus on one specific area like gas prices as people have in the past and saying, hey, inflation's not really that bad. It's just this one thing that's getting worse. Right now, there's no tug of war. All the numbers are moving up, which means the Fed is going to be looking at this with a lot of concern. Now, the inflation readings coming in hotter than expected are not the only thing to be concerned about as an individual, because that's not the only thing the Federal Reserve is looking at. In fact, they're looking at things like consumer sentiment and job openings, both of which have had surprise improvements over the last few weeks. This means that an increase in interest rates by 75 basis points is almost guaranteed now, and many people are now betting on a 1% hike. Because of this, we are seeing big moves in asset prices across the board. Let's look at the dollar first. We are seeing an increase in the dollar versus its basket of other currencies. Yet again, we are seeing this chart goes back all the way to 1984, and very rarely does does it get above the price at which it's at right now, again, relative to other currencies. Only briefly does it spike above this line because a strong dollar tends to cause problems, major problems around the world. And so once it starts to break the global economy, things tend to revert back to the mean. But we are getting into that territory very quickly here. We are also seeing a surge in the 2-year interest rate as these treasuries are going to respond very heavily to interest rate expectations from the Federal Reserve. Zooming in here on the daily chart, we can see a massive move here in the 2-year yield today. Because of these moves, we're also seeing a collapse in the gold price, a reversal in the silver price, which, by the way, those have been showing strength lately because of some major draining going on in the vaults. And that's a story for another time here. But right now, at least, we are seeing a reversal of those price moves. Bitcoin is starting to fall very quickly as well. And the stock market across the board has reversed much of its gains from the past few trading sessions. It's because of crazy moves in the stock market like this that I created my portfolio allocation mastery course, because you don't want to be subject to massive drawdowns in your portfolio and then have to wait months, years for it to come back. You want to be able to stop your portfolio from being vulnerable to those massive crashes, because then you can take advantage of the moves back up. You're not just getting back to even, you're actually gaining from there. If you're interested, I've got a discount link in the description below. We're also seeing mortgage rates starting to increase even more here in response to the strong economy and the expectation that the Federal Reserve will continue to increase how aggressively it is fighting inflation. Mortgage rates going up, that's going to cause even more pain for new home buyers and more pain for anybody who's being forced to sell their homes right now. Not many people, still a lot of people trying to sell at a gain compared to where they bought it, but this could severely impact the number of people who are able to afford a home at current prices, which means that more than likely this is the time where it is very, very important to bulk up your savings. Start saving so that you have dry powder. You have the cash to be able to afford assets when they're on sale. Maybe they're not going to look like they're on sale in dollar terms, but when assets go on sale, you want to have the dry powder. You don't want to be the one with your own blood in the streets. You want to be the one that can go in and pick up those deals, because they don't happen very often. And since the bust is an inevitable outcome of the boom, because the boom was caused by an artificial expansion of the money supply built on credit, we know that tightening into a bust is only going to make that bust worse. So get ready, because there's more pain coming, and that means more opportunities. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.